Hey guys, thank you so much for being here. I'm going to do kind of the same show we did yesterday afternoon. We kind of did a little option trading show, option strategy talk show. So we're going to do the same thing today. I'm thinking about calling it, if it becomes a daily or a weekly thing, maybe I'll start calling it the Option Bro Show or something more catchy. But the good news is Matthew Tuttle put out a new newsletter today, and the better news is he does it every day of the week. And the other, even better news than all that is it's free. So go sign up for it. And I don't have any kind of partnership with Matthew or anything. I just think there's really good information in the letter. Also, I do like Matthew because he's an option bro, and I'm trying to learn. I'm trying to pick up stuff that he knows from his years of working on Wall Street. So, and I think in his letter, his daily newsletter, he's given us some insights into that. So let me show you what I have. Let's just kind of review this. First of all, I made a nice PDF for you guys. I made it for me also, but this goes into detail. This is for the option bros that want to look into these trades a little bit closer. But let's take a look at Matthew's newsletter. This newsletter is called The Heat. Here's where you can join. I'll put it in the comment section. All right, so here's what it looks like, but we're going to focus on the option part of today. His overall strategy is called HEAT. It's an acronym, stands for hedges, edges. I always forget what everything is. Asymmetry. T is themes, not trends. That's somewhat similar to a trend, though. Hedges, edges, asymmetry, and themes. That's Matthew's idea. Today we're going to be talking about the hedges, but in his newsletter, he usually mentions all of these. So let's read his newsletter together and see what it says. He said, IBIT just became a real option tool ETF. Of course, IBIT is the ETF that's based on Bitcoin. It's the most liquid. I think it's the best one for option traders. I believe it's the biggest ETF based on Bitcoin. I could be wrong though. IBIT have just had weekly options before now, but they just rolled out Monday, Wednesday, and Friday. And that's usually the first step. I would imagine sometime in the future, they'll have Monday, Tuesday, Wednesday, Thursday, Friday. And I've made this prediction before, and I'll make it again here. Sometime in the future, you'll have 7-day expiration, in my opinion. All right. So anyway, they've added 2 expiration cycles. This is big for hedgers because this means as a hedger, you can hedge a smaller slice of time. You have more control over what you're hedging. Okay. So in other words, on these Monday, Wednesday, or Friday, you can sell a 1-day slice of premium. If you sell an option at the end of the day on Tuesday, that's basically an ODTE. Or you can wake up Tuesday morning, or you can wake up Wednesday morning and you can trade ODTEs. Basically, it's like an ODTE, even though they don't have 5-day-a-week expiration. On Wednesday or Monday or Friday, you can trade ODTs. So you basically have 3 ODTE days. So he has a few ideas. The cleanest use case for hedging with ODTE is he's saying is covered calls on your IBIT holdings. I know I'm probably going to get some disagreement on that. We've talked a decent amount about this over the past couple of days. This isn't a hedge, but it's a premium harvesting overlay. The edge comes from 3 realities. Time decay is your friend when you sell very short-dated options. I'm just going to say time decay is always your friend, but especially when you sell very short-dated options. Number 2 is you're not married to the position. The cheat code is in covered calls is closing them early. So he's saying you sell the call or write the call, initiate the position when volatility is elevated, often after an up move. But then you try to buy the option back when the option's down 50 to 80%. So if you sell an option at 3 and it drops to $1.50, $1.25, $1, according to him, that's a time that you could get out. Don't stick around for the last hour when one headline or one tweet can turn into a problem. So, and he's saying you could use this like a hedge. It's not a hedge, but you can use it to generate income on a market that's declining. You still get the income, and in fact, you may not still be ahead in the position, but you'll be better than you otherwise would have. And you can do this 3 times a week. The 3 times a week is getting your velocity, the velocity of money has something to do with how it works out also. So it's also about a mindset shift. You're not trying to win the entire Bitcoin move. You're just trying to rent out volatility for that little 1 day period. Now, these are two things he mentions important. ODT call writing is short something called gamma. I don't talk too much about gamma on this station, but gamma is the rate of change of delta. It's the second order derivative of delta. We'll talk about it some other time. What he's trying to say there is stay small because it's short gamma. Gamma is dangerous. And when you're short gamma, gamma can explode on you. Like I say, gamma is a second order derivative of delta. So yeah, gamma is explosive. When you're buying options, you're hoping for you want to be long. When you're buying options, you're long gamma. Usually, when you're selling, you're short gamma. When you're long options, you want a gamma explosion. But when you're short options, you absolutely don't. You could think of it like a volatility explosion too, but it's a little different. Anyway, Bitcoin trades 24/7, and of course, IBIT doesn't. So if you sell something at the end of the day on Thursday, thinking, okay, it's just 1 day till expiration. True. You're basically in the same situation that a lot of funds use. They sell options or ODTs right at the end of the day and cover the next day. Or not a lot of funds, but Defiance does that. And there's another fund that does too. I'm drawing a blank. Anyway, just remember this trade is not a hedge. If you sell, it trades 24/7. So you have overnight exposure. So you could wake up to a big gap against you. The too long don't read this. He's telling you not to sell. I think he's telling you not to use overnight exposure on ODTs, or that's what I'm saying. Don't use overnight exposure. Be careful. Close early so you don't close early to try to cut down the risk of a gamma explosion that blows your trade out. Or you could also look at it like I say, like a volatility explosion, but you don't want your trade to get blown out. So close as soon as possible, or not as soon as possible. 50 to 80% is what Matthew says. All right. Now, here's a new trade. Or, well, no, he's showing how here it is. Hedge trade 1. Okay, so the first idea is a covered call. I'm not going to put that into option strat. I think we all know what a covered call does. That's the least interesting out of all of them. So, hedge trade number 1 is a 44.45 call credit spread plus a cheap downside put. It sounds an awful lot like a 3-leg risk reversal to me. It has 3 legs. You're selling calls to finance puts. Surely Matthew's not copying this off me, is he? Anyway, no, and of course he isn't. But let's go actually look at how this one would work out. So this is just what you're doing here is you're selling a 45, selling a 44 call and buying a 45 call. The 44 call will be more expensive than the 45 call. That'll bring in a credit. You're spending the credit to buy a cheap downside put. All right, so let's look at that. All right, so I went in and I put in the prices into these options that Matthew gave us. Here's the 45 short call. Remember, short options are below the line and long options, option you own, are above the line. Selling the 44, buying the 45. That brought in a small credit, and they're taking part of the proceeds to buy the 43 strike put. Selling the 44 for $1.01, buying the 45 for 53. So that brings in about a 50-cent credit. Then they spend about 30 cents on this put. So let's go back over here. That put right now is worth $1.42. Matthew did this trade yesterday at the end of the day. So, and actually Matthew's up about $150 on this trade. Look at that pattern. It's just like a 3-leg risk reversal. It has a flat spot in the bottom where you don't lose money and you just get to keep your credit. When he put this trade on, the market closed at like 43. The market closed at like 43.29 or something yesterday. So when he put it on yesterday, from the point he put it on, IBIT could have actually gone up a point against him if it didn't go any further than 44.17, he wouldn't have a loss on the trade. So, this is your typical take your wife to dinner trade, selling a call spread to buy put spreads. I like it. The way I usually do it different is I sell 2 call spreads to buy 1 put spread, whatever. This is just all a unit of 1. So net credit 18, max loss 82. If you want to review this for yourself, I'll share the option strat and I'll share this playbook. So hedge number 1 is a call spread plus a lottery put. All right, hedge number 2 is a put ladder back spread. So this one's interesting. Let's go look at hedge number 2. All right, so Tuttle put ladder. This one's up $63 at this point. So this one uses 3 puts, 1 unit each. Remember, below the line is a sold put. So he sold the 45 put. 45 put is a higher price, so it's going to be worth more money. So he sold the 45 put. With the proceeds of the 45 put, he could buy the 44 put and the 43 put. So he's short 1 put, long 2 puts, which gives you downside convexity, which is what he's looking for. And here's what the profit loss looks like on that. So it has a valley of death. It's not really a valley of death, it's a canyon of death. Or, because the valley is like a V, and this is more like I guess this actually looks more like a value. I don't know. But anyway, it's a little bit of a different formation because of the put spread ladder. What I love about this trade is you can sell a 45, buy a 44, and buy a 43. What I love about that trade is you do it for a credit. And if the market goes way up, I mean, it's a big move to go up, but if the market goes way up, you don't lose any money. So on a big up move, you're fine. Because remember, these are overlays for somebody that already has Bitcoin. This isn't just a standalone trade. So, but if Bitcoin doesn't move, the trade would lose $80. But if Bitcoin's dropping like a rock, it is today, this hedge is worth money right now. So let's see what IBIT's doing. Yeah, and IBIT's close to the lows for the day, right there. Okay. All right. So that's trade number 2. Now let's go to trade number 3, which is the Tuttle bullish ratio spread. This one is actually down $4, but let's go see what Matthew says about this one. This one right here is a long 1x2 call back spread. See what Matthew says. Okay, strategy number 3 is a long strategy with downside protection. So it's a 1x2 call back spread. So you're going to sell the 44 strike call for $1.01, and you're going to buy 2 45 strike calls for 53 cents. So that's going to be at a small $5 debit, of course. 2 times 53 is 106 minus 101 is $5. So it's a $5 debit to put this structure on. Matt's calling it a cheap convex bet to the upside. Limited loss if IBIT is flat or down. Big upside if IBIT rips. But a nasty air pocket if IBIT pins. In other words, doesn't move and it stays near the short strike. So it's the 44 strike is poison. If it doesn't get more than 53 cents away from the 45, or if it doesn't get a certain amount, it doesn't get as far away from possible. If it stays close to the 44 strike, the trade's going to be a loser. Let's take a look at what happens, because it's going to land in the valley of death. And so let's see what that all value. So let's do this. Okay, so there's what the trade looks like. Right there, the dotted line is where the market is. So this trade's going to lose $5 a day. But if you wanted to make a bullish bet, and if you could get the market going up, now, like I say, the way you lose is if it lands right at, or actually if it lands right at 45, that's your loss, not a 44. I'm sorry. Okay, he's saying this is not a hedge, it's a breakout weapon. Small cost, big upside if we rip. Trade-off is you get hurt if IBIT goes up a little bit, but not enough. All right, the takeaway is these IBIT expirations, the Monday, Wednesday, Friday, don't magically create edge. They create control. Control over time, which is shorter window, control over exposure. You can choose intraday if you want to, and control over budgeting your hedge, because you can run protection in smaller increments of time. You can bite off smaller chunks at a time, and so it helps you micromanage your hedging costs. All right, so let's go. We had similar content yesterday. Let's go see how Matthew's trades from yesterday are doing. And I put up one also, that a competing trade. We'll see how it's doing. Okay, these first three are today's trades. They expire in 1 hour. So these are the ones we just looked at. The bearish hedge is where he sold the 3-leg risk reversal, where he sold calls to buy puts up about $160. The Tuttle put ladder, where he did 3 puts, he sold 1 put and bought 2 puts lower. That one is up $68, and the ratio spread is going to lose the $5 that it cost to put it on. Okay, so let me see here. Wednesday. Oh yeah, and all of these options he did yesterday, but they expired today. So they're examples of ODT. So these aren't from his video, but I took his video yesterday and I put his strategy in, and I'm putting my strategy in too. Now my strategy beat his strategy yesterday, but his strategy's beating mine today. His strategy's up $630. My reverse calendar ratio spread, my whatever you want to call it, I haven't found a name yet, is not doing as well. It's only up about $50. Okay, but let's look at Matthew's idea for today. So this is his 3-leg risk reversal. We saw this today in IBIT, but this is basically where you sell calls or you sell a call spread. I mean, the risk reversal is technically just where you sell a call and buy a put, but you could also, it's a defined risk reversal if you sell a call spread to buy a put. So that's all this is, or a 3-leg. This one was not a take your wife to dinner trade, because the way Matthew structured it, this one was done for a debit. So this one cost $177 up front, but I mean, that's $177 well spent because this trade is doing well. So that's Matthew's, and I did an alternative where I just turned it into a calendar. And so Matthew's trade's up 707. My trade's only up 150 today. It's only up about 150 right now, but I know that barely looks like it, but we could do it like that and make them look for it. But anyway, all right. So we'll see how those end up. We'll tie the game at 1-to-1. I'm gonna do another. I'm gonna keep doing this for a couple of weeks. The ratio calendar, and then Matthew's idea on the cues, and kind of get a just kind of to take a look into them. But these other ideas are good. I really like, I think his best ideas are just those 3-leg ideas. I mean, those are the ones that I like the most. So his 3-leg idea today is up about $700. His 3-leg idea for yesterday, which I have content on with Matthew's, the Siegel trade. Now, yesterday, his trade made 130 and my trade made 700. Today, we're opposite, so we'll see. But this isn't one of Matthew's trades. This is, well, never mind. That's one. So we're not going to talk about it. It's not one of Matthew's. All right. So we'll look at what's active right now. So what was the BRR? The BRR was a back ratio, a bullish risk reversal or a bearish risk reversal. I need to switch the acronym because bullish and bearish start with the same letter. But a bull risk or a bear risk reversal. And so I was just messing around with Matthew's ideas yesterday. That's basically selling calls to buy puts. I just paid for trading one, but that one looks good. What I wanted to see is if you could go out longer than, I wanted to see what happened if you went out to the end of the week. So I did the same, take your wife to dinner, sell calls, buy puts, although it wasn't a credit. So it's not take your wife to dinner, but it was, but anyway, it was a debit similar to the take your wife to dinner trade, risk reversal, whatever you want to call it, selling calls, buy puts. This one is up right now at this point in time. This one is up, what, $800. And the good thing is if volatility goes up, look what, and volatility goes up, but for some reason the price doesn't change. And volatility is up 20% by the morning. Something, this thing's worth $1,100. It's sensitive in a good way to volatility, where volatility explosion will actually help it a little bit. As long as it's above break even. Now, if it's below break even, the extra volatility will hurt it. So look at this. Also, the extra volatility makes the break even go up. it raises your break even and it makes your current value more. But if you had a volatility implosion and it was down 10% overnight or something, you still are up about $800, but it's moving your break even closer to you. So that's how that works. We'll see how that one does. So I just for concept ideas, I just did the same thing for going out to Friday. So I did Matthew's idea, the 3-leg risk bearish risk reversal, and then I did my idea, protection until Friday, and I did a calendarized version. So and we'll see how these do. They still have a couple more days to go, but there's the calendarized version. And 1 hour, 1 hour, 1 hour. And then all three of these expire today. All right, but anyway, those hedge trades have been doing pretty well. All right, well, I'd highly encourage you guys to go read Matthew's newsletter. Go to my Patreon. You can read my article in Patreon about this. It's all the same stuff I was talking about. And then from the article in Patreon, you can download that. You can download this PDF. Now, this is a PDF, but for some reason, Patreon doesn't take PDF upload, or this is HTML, but Patreon doesn't take it like this. So I had to upload a PDF, which looks like this. It just splits it into pages, but it's super helpful. I hope it helps you. If you have any questions, hit me up in Discord or hit me up during the afternoon live stream and ask me. But I'm going to get out of here and go publish this video so you guys can see it. NASDAQ is definitely bouncing, but it's still down 1.5 points. So we'll see how it ends up. That's kind of the trend. It sells off super low, then people cover and take their money and run. It rallies, then overnight it either sells off or the next morning it does. I mean, that's kind of the pattern. There was yesterday's bounce. Here was the day before's bounce. Here was the day before's bounce. Not what not what you want to see. End of the day bounces that during a bull run. During a bull run, sometimes you see end of the day sell-offs where people have made money and then takes the profits off the table. Lots of times it's related to day traders who made money squaring a position where they don't want to stay short overnight, but they want to take their money off the table. So all these people cover towards the end of the day. We have about 1 hour and 15 minutes left. Lots of times it creates a bounce. All right, guys, thank you so much, and I will talk to you guys soon.